Hi, my name is Paul, and I'm someone who regularly consumes investing content on YouTube and elsewhere. And over the years, I've heard numerous mixed messages regarding the size of a company's market cap, and how market capitalization pertains to risk and reward. Unfortunately, the lack of consensus on this topic, even among those whose job it is to manage others' investments, is almost certain to confuse aspiring investors looking to gain fruitful information. So, I'm making this video for investors who want to find out if larger market cap companies are safer, or if market capitalization and safety are completely uncorrelated. To get to the bottom of this, join me in uncovering the truth about what a company's market capitalization really means, as well as what this metric can tell us about a company, and equally importantly, what this metric cannot tell us about a company. First, let's go ahead and define what market capitalization means. And it's a pretty easy definition to remember. The market capitalization, or market cap, of a company is just the price tag that you would pay if you were to buy all of the shares of a business at the current stock price. So, to calculate a company's market cap, you would take the price of one share and multiply that by the company's total shares outstanding. Now that we have a working definition and a formula for calculating the market cap of a company, let's get into what the market cap can actually tell us. Well, the market capitalization can tell us the total cost of buying all of the company's shares at the current share price. And that's literally it. At least on its own. See, the market cap is a key component of many formulas that are commonly used to determine the value of a company. For example, one way to solve for the price-earnings ratio would be to divide the market cap by the company's net income. You could also similarly divide the market cap by the company's revenues to figure out its price-to-sales ratio. Or you could use the market cap to calculate the enterprise value of a business by adding the market cap to the market value of debt and then subtract any liquid assets. In fact, the market capitalization is used to derive so many different formulas used by investors that I could probably fill the remainder of this video just listing them out. But there's a lot of other stuff to get to, so even though the market cap of a company is essentially just the current price tag on a business, you should not come away from this video thinking that the market cap does not matter. Market cap matters. A lot. But on its own, the only thing that the market cap of a business can tell you is the current value of all of the company's shares of stock. Now, I already know for a fact that there are going to be many people watching this video who disagree with this notion. If you're one of those people, then this video was actually made for you, or rather the me of 7 to 8 years ago. See, for a long time, I believed that you can glean some very important insights into a company from knowing the size of its market cap. At the time, it was obvious to me that a company with a large market cap is going to be a safer and more secure investment than a company with a smaller market cap. Unfortunately, as obvious as it was to me then, this is demonstrably not true. To show you how, let's say that there are two companies. Company A has a market cap of $10 billion, and Company B has a market cap of $10 million. Given only the market cap of these companies, what additional insights can you draw from these examples? Would you feel confident that Company A is a more secure company, or that Company B were a riskier investment? What if it turned out that Company A was a crypto brokerage that wasn't yet profitable? And what if it turned out that Company B rented out farmland and generated profits of $5 million per year? I can guarantee you that these revelations have greatly changed your perception of the security and safety of these investments. Most of you watching would probably jump at the opportunity to purchase ownership in land that brings in an annual 50% return on invested capital. And I think you'd also be likely to shy away from an unprofitable crypto brokerage, arguably even more so if the market capitalization were inflated to an even higher $100 billion. Furthermore, if we went back in the example to when you just knew the market caps of the two businesses, had I revealed that Company A and Company B were in fact the exact same business, you almost certainly would not feel any safer about having paid 1,000 times more for ownership in the same company. So if it logically does not make sense to use market capitalization to assess the safety of an investment, where does this idea come from? Well, my old go-to argument was that large market cap companies are typically safer investments because they're more likely to survive during economic downturns. The question now is, why are large cap companies more likely to survive than small cap companies when the going gets tough? The top answer on a popular investment site claims that because large caps are considered to be more mature and less volatile, they're also considered to be more likely to survive during a downturn, because investment money flows into them during these times. To current me, this answer is incredibly dissatisfactory for several reasons. But the most egregious of these is the circular logic being used to uphold the premise. See, if large cap companies are less volatile because more investors pile money into them during times of volatility, and these investors pile money into these companies because they believe that they're less volatile during volatile times, this is creating a self-fulfilling prophecy. So, in essence, the belief itself is creating a perpetual cycle that is either dangerously propping up an incorrect belief or diluting a correct belief. For instance, from the logic being used, we cannot delineate if the large market cap companies are receiving investment capital because people simply believe they're safer investments, or if these large cap companies actually are safer investments. What's scary about this is that in the first instance, where the larger businesses are not actually safer, many investors will invest under the false pretense of security, which will lead to more instances of lost capital when the cycle inevitably fails. However, in the second instance, where the larger businesses are truly safer, the investors using this poor circular reasoning to arrive at the correct conclusion never truly know if large caps are actually safer, because they can't rule out the possibility of the first instance being the truth. Now, to be fair to those who believe that large cap stocks make for safer investments, there are stronger arguments that can be made. For example, companies with larger market caps are more likely to have achieved greater scale and have lower marginal costs, which will contribute to greater resilience against rising operational costs and even lower levels of demand. In the aggregate, this is absolutely true. If you were to randomly select one large cap company and one small cap company, chances are the larger market cap company is operating at a greater scale, giving it additional defenses. On top of that, the argument could successfully be made that on average, large market cap companies tend to be more profitable than small cap companies. And on average, large cap companies tend to be more mature than their small cap counterparts. This is irrefutable. Obviously, companies who are just starting up are much more likely to have lower demand and stability, and will disproportionately trend towards being smaller market cap companies. Meanwhile, large cap companies will disproportionately make up businesses that have been successful on a large scale for long periods of time. Unfortunately, this line of reasoning can take investors in the wrong direction. This is because it's important to realize that no investor who is analyzing or comparing individual securities should be conflating one company's traits with the average of its peers. So, if say the average small cap company is unprofitable, that doesn't mean that every small cap company is unprofitable. Nor does this average have any bearing on whether or not a specific small cap company is unprofitable. To push back against this a bit further, I would argue that the act of investing in individual securities is indicative of a desire to find securities that will outperform and that are above average in quality. So, if in attempting to select an outperforming individual business, an investor were to completely write off small cap stocks using the logic that small cap stocks are on average less safe or secure, that investor would probably be acting against their own best interest. See, if the safety of an individual security is the factor that's being considered, why would an investor ever choose to look at the market capitalization when other metrics like expenses, margins, debt levels, or liquidity are available and give a much more accurate and precise telling of safety? And this isn't a rhetorical question. If anyone has a well-reasoned answer, then please feel free to leave a comment. Discourse and civil debate is always encouraged here. That said, before I start getting comments pointing out that filtering companies by market cap will reduce the likelihood of investing in unsafe stocks, I want to note that this is not a very useful solution. That's not to say that this won't effectively reduce the number of bad investments that you come across. It definitely will. Instead, I would point out that this is a bad way of filtering for safe companies, since you're not reducing the likelihood of coming across risky large cap companies, but you're completely eliminating the possibility of coming across any safe or high quality businesses that happen to have a small market cap. So, rather than screening for market capitalization, investors would be much better off, in my opinion, filtering for more relevant criteria like profitability, sector, indebtedness, or growth. Another argument that I used to believe very strongly was that small cap stocks are more likely to be caught up in securities fraud, and so they should be avoided. This is another broadly correct statement that misconstrues the nuances of the topic. See, the vast majority of small cap securities fraud stems from reverse mergers and market manipulation in the form of pump and dump schemes. Now, reverse merger fraud isn't something that is going to be applicable to probably any of you watching, but I will briefly go over it. So, a reverse merger happens when a publicly traded company that has minimal operations is bought out by a private company that has operations. This private company then takes on the name of the public company whose shares are traded on an exchange, allowing the private company to bypass the listing requirements that a company normally would have to go through in order to get onto the exchange. Now, a reverse merger in itself is not illegal, but because the merging company who's gaining access to the exchange is not required to prove its legitimacy ahead of time, this process naturally makes for a pretty useful loophole for prospective fraudsters. Thankfully, unless you're somebody who's willing to gamble your money in a shell company that has virtually no current revenues or income in the hope that one day the perfect company will come along and carry you to wealth, unless you're acting that stupidly, you won't have to worry about your investments being impacted by reverse merger related fraud. That leaves us with the pump and dumps, which are frauds that usually involve individuals or groups who build up a position in small cap companies with low trading volumes. Once these scammers have bought up their shares, they'll announce to a group of hopeful investors that they found a great new stock that is set to dramatically increase in price. This creates lots of demand for shares that have a low relative supply, leading to rapid share price inflation. This growth then drives even more attention and investment into the stock, at which point the scammers offload their shares for huge profits, crushing the demand and leaving the duped investors holding onto a security that they've substantially overpaid for. This is obviously horrible for small cap companies, but again, it fails to address the earlier criticism of poor filtering. Now, yes, you could screen out small cap stocks to come across less pump and dump schemes, but doing so would still expose you to larger market cap companies affected by similar frauds, and it would still eliminate the possibility of investing in high quality small cap securities that are unaffected by these frauds. So, to avoid companies that are pumped up to abnormal prices, you would almost certainly be better off filtering out companies that are trading at abnormally high valuations relative to their historical ranges. And I'd be very surprised if most of you don't already have several methods that you use to avoid overpriced securities, so I won't waste your time with more examples here. Delving a bit further into the topic though, there is a bigger social issue here that arises from the objectively true statement that companies with smaller market capitalizations are more likely to be involved in securities fraud. The key issue here is that the majority of investors do not have a full understanding of what securities fraud entails. Still, while writing this video, I found myself curious about whether or not there actually was any truth to the idea that small cap insiders were less scrupulous than the insiders at large cap companies. So, I read several published academic articles and looked at the data provided by the Securities and Exchange Commission. And what I found was, the data is fairly inconclusive, but there just might be a correlation here. See, the publication that came closest to definitively answering my question was called Stock Market Manipulation, Theory and Evidence. This article was written by Rajesh Agarwal and Guojun Wu, and it was published in the Journal of Business back in 2006. This paper looked at 142 cases of stock market manipulation that occurred between 1990 and 2001, with the intention of studying what happens when a manipulator trades in the presence of others who are seeking out information about the stock's true value. So, not exactly the same topic, but the study does reveal some relevant details though there were limitations to the data that was collected from the SEC and used in this study. Still, the study did find that in nearly 50% of the manipulation cases, insiders were responsible, and that over 50% of the manipulated stocks were penny stocks with very low average trading volume. Unfortunately, how much more than 50% was left unspecified, and the term penny stock was never defined in the article. Furthermore, when it came to the specifics regarding which markets experienced the most manipulation, surprisingly, the Nasdaq small cap market was found to have the lowest levels of market manipulation, making up only 1.4% of all cases. Meanwhile, the markets with the most cases of manipulation came from the OTC category, which included both the over-the-counter bulletin board and pink sheets markets, representing nearly 50% of all manipulation cases. Unfortunately, the glaring issue here is that nearly 30% of cases did not have information available denoting the specific exchange where the fraud was committed. So, potentially, any of the numbers here could be off by as much as 30%. Though, if I had to guess, I would say that most of them also probably came from the OTC category. Now, the reason I'm pointing my finger at the over-the-counter markets is because the study found a strong correlation between the occurrence of manipulation and the markets that had the lowest disclosure requirements for listed firms. Back when the data was being collected, the over-the-counter bulletin board and over-the-counter pink sheets markets did not require any financial disclosures until June of 2000, and specifically the pink sheets market still has no requirements for companies already listed on the exchange, and it only has minimal requirements for companies looking to get listed on the exchange. Now, the change in June of 2000 required that all stocks trading on the over-the-counter bulletin board exchange must submit annual financial statements. And in the study, it was noted that these regulations appeared to have pushed many bulletin board stocks into the pink sheet market. Also, it was suggested that because the data was collected between 1990 and 2001, the new regulations may have an immediate and lasting impact on results post-collection. Now, to be fully transparent, there were other papers conducted on the topic of market manipulation and securities fraud pertaining to market capitalization. Unfortunately, every study other than the one that I just went through uses datasets specific to different emerging markets, as opposed to the developed American, Canadian, and European markets that I'd assume that most of my viewers would be interested in. Plus, most, if not all, emerging markets have very different rules and regulations that must be followed. And this is just a taste of the sorts of challenges that come up before even touching the data itself. Though, if it's any consolation, one study entitled Pump Dump Manipulation Analysis: The Influence of Market Capitalization and Its Impact on Stock Price Volatility at Indonesia Stock Exchange, which was written by Zainal Arifin and was published in 2018 by the Review of Integrative Business and Economics Research, found that small cap stocks on the Indonesian Stock Exchange have lower probability rates for pump and dump manipulation. That said, this finding did include an addendum stating that this could have been due to relatively low market capitalizations of non-small cap stocks on the exchange. And looking at the numbers, only 9 Indonesian securities would qualify as having a large market capitalization, assuming of course that the definitional requirement is a $10 billion plus market cap. Anyway, hopefully this detour provided some context as to why I claim that the data is lacking and more research needs to be conducted. So if there are any academics in the audience looking for an idea to write a paper on, this one would make a good contribution to the field, in my humble opinion. Before moving on, however, I want to reinforce the point made by Agarwal and Wu, that most manipulation schemes tend to occur in markets that are the least regulated. So, with regards to finding safer, publicly traded investments, your best bet would probably be to screen out exchanges that have minimal levels of regulation. Building on that sentiment, the idea of an investor putting any significant amount of capital into a security that does not have any documentation outlining the firm's financials is absolutely ludicrous. The fact that there are people willing to entrust their money within a security without viewing any financial documentation, let alone putting money into companies that don't even release financial documentation, highlights a much larger issue and circles back around to the main reason why pump and dump schemes are effective in the first place. Personally, I think that the explanation for this phenomenon is that investors rely exclusively on second and third-hand information to make financial decisions, and I believe that this drastically lowers the ability for those investors to make good investment decisions. See, another argument that is undoubtedly true is that large cap securities tend to get significantly more coverage and thus more public interest than their small cap counterparts. My question to you is that a good thing for the aspiring investor? Now, before you come up with your answer, let me rephrase the question. If newer investors were revoked of their ability to get stock-related information from sources like analyst write-ups, hedge fund reports, online or traditional media, or word of mouth, and instead the only way for them to receive any information on securities was to read financial statements and direct company press releases or listen to company conference calls, would this result in better informed decisions? My answer would be a definitive yes. In my personal experience, the majority of investors get virtually all of their information from these second and third-party sources, which I believe significantly lowers their ability to make good investment decisions. That's not to say that I think these sources are necessarily bad for investors. In fact, I actually believe that you can get quality third-hand information from sources like this very video. What I am saying is that it's very important for an investor to have a strong baseline understanding of the business before going off to, say, read an article summarizing a company's earnings results alongside analyst estimates. Instead, the first place that investors should be going to get information on a company is either to the company's investor relations page or to the regulated sites that grant access to company direct filings. This is because these sources are first-hand factual information that will then go on to be interpreted by other sources. Investors who start elsewhere substantially increase the likelihood of being misled by misinformation from sources that omit important information, are biased or incorrect, or even worse, have ulterior motives. Now, again, we've come to a whole other topic that has enough meat on it to justify its own video. But the main point is that skipping the financial statements and conference calls to read summaries or listen to other people's opinions puts investors at a huge disadvantage because they become reliant upon the interpretations made by others. This trust not only leaves one open to abuse from market manipulators, but even in the case where the information source can be trusted not to take advantage of their followers, this strategy still puts the investor in a bad position because the presenting party will always have the advantage of being able to act before their information has been presented. So, by relying on external sources, investors will be more likely to pay higher prices for securities when the presented hypothesis is that securities will increase, and the reliant investors will also be more likely to sell at lower prices when the presented hypothesis is that securities will decline in price. Chances are you're already well aware of the old adage, buy low and sell high. And I think that most of us would be better off avoiding practices that push us in the opposite direction. That said, the idea that companies with small market capitalizations should be avoided due to a lack of media or analyst coverage has another major downside, in that it's highly contradictory to the aim of those looking to invest in individual securities. See, the very reason why larger companies receive more coverage is because there's more public interest, which, in the investment world, means more capital competing for ownership. But it's not quite as simple as just more competition. When more money is involved, it also means better competition. And this is because large funds and investment managers have some of the best minds working towards finding undervalued companies that can make them the most possible money. Fortunately for the aspiring investor, firms working with massive amounts of capital also have equally massive limitations in that they're essentially forced to focus on companies with larger market caps. See, the more money that you have, the more money that you're going to need to invest in order to continue growing. So a fund with, say, $10 billion worth of capital to invest probably wouldn't waste much time looking into companies with market caps less than $500 million. The reason for this is because large funds have to make a lot of considerations. For instance, if we were operating the fund, we would need to consider how much of the company's shares we could buy before our buying pressure would push share prices above our target buying range. We would also need to consider how much of a premium we would have to pay in order to buy the whole company outright. And most importantly, we would need to consider how much would the company need to increase in value in order to make our venture worthwhile. Personally, as a retail investor working with relatively small sums of money, by myself, I've managed to push up the stock price of companies with small market capitalizations in the $10 to $30 million range on multiple occasions. And this is because most good quality companies with small market caps do not have a lot of selling volume. So it makes accumulating significant positions in these companies at desirable prices very difficult. For these reasons, a fund with say $1 billion of investment capital wouldn't even consider looking at an equity worth say $50 million, unless it had the opportunity to buy it outright, because under most circumstances, it would be almost impossible to invest even 1% of the fund's capital into that business without substantially driving up the share price. And even in the instance where that fund would be able to fully invest $10 million at a reasonable price, the company would still have to wildly outperform the market for years in order to make any significant impact on the fund's total capital. On top of that, there's also the issue of opportunity cost that the fund needs to consider. How much time, effort, and money would be spent searching through tiny companies in order to find enough investment opportunities to be worthwhile? Chances are that a big fund won't be able to find hundreds of tiny opportunities that they can dump hundreds of millions of dollars into at reasonable valuations. This is why having a lot of money can be a serious limiting factor when investing. And paraphrasing the words of Warren Buffett, having less money opens up the world of possible ideas for making very large returns. So, as retail investors with small sums of money, we have the opportunity to find a few of these hidden, tiny opportunities, and they can have huge positive effects on our relatively tiny portfolios. And while going from 50,000 to $1 million might not be worth the effort to some of these huge hedge funds out there that spend 10 times that amount on executive bonuses, it can be life-changing to individual investors like us. To summarize all of this, most analysts don't look at small cap companies because there isn't enough public interest, and most investors and funds with large sums of capital don't look at small cap companies because they can't invest enough money into them to make a difference in their total portfolio. This lack of interest by skilled investors, analysts, and most retail investors results in small cap companies having much larger likelihoods of being severely underpriced. This means that if you're someone who invests in individual securities and you aren't working with large sums of money, you'll probably find much better success by starting your search for companies with smaller market capitalizations. But before you do, remember that this video is not meant to give you the green light to go ahead and gamble on small cap stocks. Instead, make sure to do your due diligence by avoiding under-regulated exchanges, and take advantage of these regulations by going through direct channels to receive company-specific information before looking at alternative information sources. Also, make sure that any company you plan to invest in has some way of returning value to shareholders, preferably through profitability. Finally, and most importantly, make sure you understand the business that you're investing in like the back of your hand. And if doing all of that doesn't sound like it's for you, then that's perfectly okay. There are plenty of diversified ETFs that will almost certainly give you better, safer returns over the long run than if you decided to chance investing in individual securities without doing proper due diligence. And that's about all that I wanted to cover in this video. So hopefully I was able to illustrate what market capitalization is, how it matters, and of course, how it doesn't. As always, I'd love to hear your opinions on the topic down in the comments, or of course, if I missed something, then please let me know. Finally, if you found value in this video and you know someone else who might also benefit from watching it, then please consider sharing. Thanks for watching all the way to the end, and enjoy the rest of your day.